What's going on, everybody? This is Phil from Millennial Money Gains, and welcome back to a brand new video. In today's video, we are going to go over a stock that pays over a 20% dividend yield. That is absolutely crazy. We are going to go over whether this stock is a buy or whether this stock is a runaway and hide. With that being said, let's get started. Alright guys, so the stock that we are talking about today is ticker symbol GEO, that's Geo Group. It is currently trading at $6.81 at the time I am recording this video, and it pays a whopping 22.8% dividend, which is just absolutely insane. But before we get further into the stock, if you guys can, just please smash that like button. I really do appreciate it. It really does help the channel get to more people. Thank you very much. Also, if you want to join the family, hit that subscribe button down below, right down here. And you can join the family, turn your post notifications on. That way you get notified every time I do post a video. We post on here at least 2 times per week. But with that being said, let's hop right into Geo Group. So, what is Geo Group? Geo Group is a REIT, a real estate investment trust. They specialize in detention facilities and community re-entry centers. The company leases and oversees secure detention, rehabs, centers, and re-entry facilities, and service centers for troubled youth. The Geo Group also provides counseling, education, drug abuse treatment, technology-based supervision programs, and detainee transportation. The majority of revenue comes from leasing and managing U.S. correction and detention facilities. The Geo Group operates also in Australia, South Africa, and the United Kingdom. So let's just take a look at this stock and whether we should get into this or run away and hide from this. So last year they paid out $186 million in dividends. They do have a free cash flow of $332.97 million last year, which is good. That means they have the money to pay out these dividends since they are so ridiculously high. Their market cap right now is $817 million with over $2.3 billion in revenue. So not a bad ratio there. PE ratio is sitting just under 6. Now obviously with REITs it's hard to know the PE ratio because the market is fluctuating constantly. But it is sitting around a 6 right now, and they have a profit margin of about 6%. Their gross profit margin is around 82%. So let's further look into their income statement and their balance sheets. So let's take a look here. So let's take a look at their shares. So their shares have been growing constantly on a yearly basis. So starting in 2016, they had 111 million shares outstanding. 2017, they had 120 million shares outstanding. 2018, they had 120.24 million shares outstanding. 2019, 119 million shares outstanding. And 2020, 119.72 shares outstanding. So not horrible, but they are getting there, and their dividend has really fluctuated a lot as well. So just looking at this, in 2017 they paid out $1.88, 2018 $1.88, 2019 $1.92, and 2020 $1.78. So their dividend also not too shabby. Now let's take a look at their balance sheet. So they have total current assets sitting around $700 million, around $701 million. Total current liabilities is sitting at $423 million. So that's a check mark there. We do like that. And let's take a look at their cash flow. So far looking pretty good for this 20% plus dividend. So let's take a look at their net income. It has been mediocre or so. So 2018, 140.8 million, 2019, 150.8 million, 2020, 151.08 million, 2021, they're expecting 138 6.4 million, so a little decrease there. So far, not looking too bad in my opinion. So that's pretty much all I have to say about Geo Group. Now, like I said, they do pay a ridiculous dividend, and we are going to hop into their chart here in a moment and take a look at that. But they do pay kind of a ridiculous dividend of 23%. But as of right now, it looks like they can afford that. So, at least for now, I'm going to give this one a go-ahead. I think you need to stay consistent on this one. I do think that it will be a little difficult to monitor this stock, but based on their balance sheet, I am going to give it a go-ahead. Now let's take a look at their chart and see how they fared these past few years. So, in the past 5 years, they are currently down 71%, which is a big number. They were trading upwards of $30 a share or so at one point. So their stock is kind of in danger. Past year, they're down 38%. Past 3 months, they're up 14.5%. Past month, they're down 10%. Past week, they're down about 1%. And the daily, they're down a little bit today. But honestly, with the amount that you will receive in dividends from this one, I don't think it would be bad to put a little money on the side for this one. That's me personally. I may and may not do it. I am trying to get into more safe stocks, but as long as you guys are monitoring it and keeping this on your watch list and making sure that they are still paying these consistent dividends, then I do think it can be a good, potentially good stock to invest in to rake in these dividends. Now let's take a look and see how their dividend has fared in these recent years. They have a 51% payout ratio, about standard for a REIT in my opinion. It may not be the best, but for a REIT, it's really not bad. A 50% payout ratio is not horrible in my opinion. Just to compare that to a popular REIT such as Realty Income. Realty Income currently has a payout ratio of 283%. So 50%, not too bad in my opinion. Now getting back to this, they have 0 years of dividend increases, and that could be because of the pandemic last year. But so it has been seen that their dividends have been decreasing quite a bit. It was actually cut in half as of last year. Coming into this year, it was cut in half. So their dividend, it's a risky dividend, but overall I do think they have the potential for you to rake in a lot of cash, in my opinion. If you guys want to put a little bit aside just to rake in that dividend, I don't see a huge problem with it. As long as you know the risk, the dividend is not safe, the stock is not safe. But I think for a 23% dividend ratio, dividend yield, that maybe putting a little bit into this to bring up that cash flow and maybe take that cash flow and invest it in elsewhere, I think that could be a decent way of doing things. That's just my opinion. But I will let you guys know, of course, if I do add this one to my portfolio. From what I'm seeing, it's not a horrible. It's for a 23% dividend yield. I was expecting a lot worse. But it looks like they can afford that for now, and we will just see and potentially in the future. But I want to thank you all for watching this video. I do appreciate you all, and I will see you guys in the next video. If you guys did enjoy, please make sure you smash that like button if you got anything from this video. Also hit that subscribe button down below. Make sure you join the family and stay up to date with the videos. We post here at least 2 times per week, and I will see you guys in the next video. Peace.